is paid to a associated enterprise, which is available in a subsequent year. I think the expectation is that this will all be seamlessly available. And I think the residual clause in the repeals and savings should be good enough to cover such situation. Uh, Generally, taxpayers should not uh, budget for any difficulty on these accounts.
I would totally agree with that. Absolutely.
We move on to the next, another subtle but important aspect is that there are various 43B payments wherein the deduction is allowed on actual payment basis, which are your statutory payments or the interest payments to the financial institutions. And it is irrespective of which accounting year it follows or when it is accrued as such. But one of the aspect which is there that you can claim the benefit of deduction under 43B equivalent only if it is otherwise allowable under the law. In the original bill, this term otherwise allowable was not there, leading to a potential interpretation that if a particular expenditure which would have not been otherwise allowable, say for example, those would have been disallowed under proviso to section 37(1) for any violation of law or anything of that sort, one would have taken shelter of 43B to say that okay, it is made payment and there has been no restrictions under the law to claim that deduction. And also it deals with otherwise allowable on the timing of the allowability also. Or if something which is say contingent, which is not otherwise allowable, but would have made the payment of that, then also one would have claimed that. So this, in a sense, the dichotomy has been addressed and it has been restored to the current provision to say that you can claim deduction of these statutory payments on payment basis only if it is otherwise allowable under the provisions of the Act as such, which is in line with the current provisions of the Act as well. And the same has also been drawn in terms of the definition of the sums payable, which is providing that if it is incurred under the law, even though it has not been specifically provided for in the books of account, then also the deduction would be available basis the definition of sums payable, which is there under the current provisions of 43B, which they have also brought in under the new income tax bill as such. So it is more of a course correction of what kind of expenditure can be claimed under 43B equivalent on payment basis subsequently when the bill gets enacted. The other, which is more perspective from the corporate perspective, is on the preliminary expenses. So whenever any new entity is set up or there is an extension of the undertaking of an existing company, there are certain deferred revenue expenditure which are allowed on the specified preliminary expenses. So it is falling under two categories. One is the general preliminary expenses on the feasibility report and etc. And specifically for the corporates, there is an additional deductions which are available for additional expenditure in terms of public subscription issue related thing, commission, brokerage, underwriting fees, etc., which is there. But the way the original bill got drafted, it gave an interpretation that for the purpose of corporate, only these expenditure are allowed, which is relating to MOA or public subscription, and not the otherwise generally allowable, which is available for all category, which got picked up as per the discussion with the select committee. And that's where they have added the word addition to say that, okay, while general preliminary expenses is allowed to as a deduction, if it's a corporate and if you are incurring this expenditure on public issue or anything, that would be an additional allowance that would be available on a deferred revenue basis.
Abhishek, when we look at 35D, I think the 35D is very complex in terms of giving effect to, and there was a expectation that all of the expenses incurred in a public issue, all of those will get allowed over a 5-year period, but that's not happened. The issues where the continuity was lacking, those have been rectified, but I think this is something which we can look forward to as a policy change.
Absolutely. So, Umesh, I think you meant for the private placement expenditure which is there. So currently the section only restricts on public issue, and if there is a private placement, such deductions are not allowable. And there was expectation that they could extend those benefit even for the private placement issue which is there. But that is something as a policy change which one could or one may expect to be addressed in the forthcoming years. Now, from an R&D expenditure perspective, and this is particularly from a weighted deduction. So today there is approved facility by the DSIR where the facility is approved, and basis that the expenditure on the R&D is allowed on a weighted deduction basis, which now have reduced down over the period. And even for an unapproved facility, so for which is an in-house R&D expenditure, there also weighted deduction was available for revenue and also the capital expenditure, except for the purpose of land which were there. But the way the language got enacted under the original bill, it appeared that even for the normal in-house expenditure, which is not pertaining to approved R&D facility, those deduction will not be allowed unless the corresponding facility is approved. Again, that has not been the intention. The law has always been interpreted to say that, okay, approved facility will have its own deduction, but even if it is not an approved facility for the specified sector and for the specified expenditure, those still would be allowed as a deduction. So that dichotomy also, it has been addressed to state that whatever are the expenditure allowed for the approved facility would be governed by the specific provisions of the law. But over and above that, if there are anything which is pertaining to normal R&D facility and this thing, that would be independently governed, and it will not have any overhang on whether it is approved or not approved. So this is again a welcome move in terms of ability to claim 100% expenditure on approved plant and machinery or the building R&D which would be there.
And Abhishek, this also makes a lot of sense because we now do no longer have weighted deduction on in-house R&D facilities, and therefore I think this doubt has been set to rest.
Yeah. Then is on the normal rent and repairs, which is there. There also there were minor miss in the original bill in terms of not specifically mentioning about allowing of the repair expenses on the plant and machinery, which has been restored. And they had specifically brought under the original bill that the repair and rent would be allowable only if it is wholly and exclusively used for the purpose. Now, there is a separate provision under the law which gives an assessing officer the right that if a particular expenditure is not wholly and exclusively used for the purpose of business, then he need to bifurcate in terms of what is allowable for the business purpose and what is not for the business purpose. So those provisions were also there. So therefore, there was no need to specifically bring out the term wholly and exclusively, which has got been removed from the new bill which is there. Then the next question, and it's again a technical thing which is there, that today what we call it as a company in which substantially interest is as a closely held or the private company and the widely held company. And there are different corresponding provisions in terms of deemed dividend or carry forward of losses attached to both the widely held company. There are two specific conditions for any company to be treated as a widely held. And these are like either conditions as per the current law. Either the corresponding company is listed as on the last date of the previous year, or it is 50% or more held by the another widely held company. So if you satisfy either of these condition for a public company, then it was held to be a widely held company. But the way the language was drafted as a part of original bill, it gave the indication that you have to satisfy both the conditions, which in a sense would have been a very, very weird interpretation, or which would have led to an inconclusive conclusions on the interpretation. So those has been addressed appropriately to say that the current position of the law to satisfy either of the conditions, either being listed or being held more than 50% by the another widely held company, that will prevail and not both the conditions would be applicable. Now, this next topic, and which has been an most debated topic in the recent times after the IBC law got enacted, and is in terms of waiver of any loan during any IBC related acquisitions while acquiring any different company or any loss making company. Now let's get into the history of it. Earlier, all throughout, the characterization of any waiver of loan would depend whether it is on a capital account or a revenue account, and the jurisprudence have on the facts laid down various principles for and against in terms of, but the underlying principle of that was if it is on capital account, it would be treated as a capital receipt, and if it is on a revenue account, it would be treated as a revenue receipt. Then there was a Supreme Court decision of Mahindra, which laid down in a sense a different or and another angle to say that a waiver of a capital is something which is a cash receipt, and what is covered under the provisions of 28(4) in terms of any benefit or purchase, it has to be a non-cash. And hence, all that debate on capital and revenue, in a sense, got into a different direction to see that it is not applicable per se because it is on capital receipt. Then there have been an amendment under the 2023 Finance Act to where they have imported the word whether it is for benefit or purchase it, whether it is in cash or not, which is there. Though they retained the other language of the 284 in terms of it has to arise from the business. Now, from a department perspective, again, department has its own explanation in terms of the treatment that it intends to follow. So under 194R, which is a withholding provision corresponding to any benefit or cash which is there, but the language in a sense is pari materia with the 284 which is there. They have selectively said that, okay, if the waiver of loan is happening in terms of from any of the specified financial institutions, there is no requirement of 194R there. But they have caveated to say that it is only withholding relief that is there. The taxability of that would be determined basis the prevailing provisions of the law. In the select committee, and there was a recommendation from the industry as well as from the select committee, and more interestingly, even from the Ministry of Corporate Affairs, while dealing with the new income tax bill proceedings, to specifically grant an exemption or explicitly mention it under the provision of the law that such waiver of loan, especially in the IBC acquisition situation, will not be subject to tax under 28(4) equivalent. But the response which the MOF said that they have already safeguards provisions under the law in terms of protection of the loss for any change in shareholding under 79. Those losses could be sufficient enough to set off any, so to say, income that would be arising on such waiver which is there. And even under the Ind AS accounting perspective, these have been treated as credited to your P&L account. And there have been various precedents in the past which have held it to be as an income. So therefore, the interesting part is now that the language of 28(4) even today gives a certain interpretation issue, and there could be a possibility to argue that even today under the law, whether it is a cash receipt or a not cash receipt, one has to still test whether it passed the muster of 28(4), and the language of which is pari materia in clause 26 of the income tax bill. And there are workable arguments. It uses the term arising from the business. So whether one has to be into dealing into that business of money lending or not, whether it is relating to the core business, whether it is as a part of a trade advance, that only gets covered, or then the ultimate part, whether still I have to take the shelter of capital versus the revenue receipt which is there. So this still interpretation which are in a sense available, and courts have also dealt with this aspect of revenue versus capital even after the Mahindra decision which have been there. But after the amendment under the Finance Act 2023, there has been no known precedent in terms of dealing with these aspects, whether this would get covered under the 28(4) or not. So there are arguments to say that it would be still able to take a call that it should not be taxable, and it would be depending upon the facts of the case. The Minister of Finance has its own intention, which is only covered in as a part of an intention, but not explicitly brought under the law. So now the courts will now interpret, and it's like a new round of interpretation that will happen in terms of 28(4) and 28(1) to see whether any waiver of such loan in the given circumstances of the fact would at all be taxable, even under the change in the law to say that cash receipt is also covered as a part of benefit or purchase it.
So Abhishek, waiver of loans has been a flavor in terms of how 28(4) will apply. The same provisions continue as far as the new act is concerned. The MOF CBDT has not even dropped a hint in terms of whether they are okay with the select committee. They have left it to the judiciary. But I believe that, given the strong recommendation from the select committee, I think taxpayers could use it as a persuasive argument. Again, no precedents are set, and therefore, finally, the call will be with the judiciary that even after the language change under 28(4), whether waiver of loan is taxable. Uh, yeah, Vijay.
Yeah. Then is on the presumptive scheme of taxation for non-resident, and specifically if I talk about a new provision got introduced under 44 BBD, which gave presumptive taxation for a non-resident providing any services or technology in the space of electronic goods manufacturing. And there was a ask to say that For other sectors, especially for the turnkey projects, there is an option available to offer lower profit or to claim losses if they are maintaining the books of accounts and the audit which is there. But that request has not been accepted. It was not there under the Act, and even it has been reaffirmed under the new provision of the bill that that option is not available for this particular sector. Interestingly, for other sectors, let's say shipping or the aircraft, the current provisions of the law does not have the option to claim lower profit. The original bill, when it got introduced, it gave that option to everyone as such. So then even the sectors which were not currently available for claiming lower profit, they would have claimed lower profit by virtue of filing the maintaining books of account. But that they have again corrected it under the income tax law to state that whatever that to whichever sectors it is currently available under the law, which is for the turnkey projects and all, it will be only available to them and it will not be extended to any further sectors as such. Then there was again an issue pertaining to of accrual of the royalty if it is paid between one non-resident to another non-resident. So currently that royalty is taxable in India only if it is pertaining to any business which has been carried on in India. But the original language suggested that even if it is for the businesses pertaining to outside India, that would have led to an income accrual, royalty accrual in India. That anomaly they have corrected and said that any royalty payment on by between two non-resident, it would be taxable or accrued or deemed to accrue in India only if it is pertaining to businesses in India. Now, one of the huge aspect and where there was a huge UN try was applicability of the AMT provision, which is the alternative minimum tax for non-corporates, especially if it is pertaining to the case where they are not claiming any profit or investment linked deduction. So under the present Act, AMT is applicable only if you claim any profit linked or investment linked. But this specific carve out was not there when the original bill got introduced, meaning thereby any income which is lower than the 18.5 percentage AMT rate which would be there, then one have to pay the AMT under the deemed fiction. So say for example, the family offices and all which are under the LLP structure or the partnership structure, where potentially the long-term capital gains would have been taxed at 12.5 percentage. But because of any specific exemption to carve out those structures which are not claiming any investment or profit link deduction, they would have ended up paying MAT tax at 18.5 percentage. But they have restored the current provisions of the law to state that the provisions are applicable only when you are availing investment linked or the profit linked deduction as such, and therefore in a sense it is a bit relief for various entities where there are capital gains tax attracting lower rate of taxation. The next 2 points are again, it's more of a course correction to align with the existing law that if currently any assets or SPV are transferred under the business trust. So while there is an exemption available under section 47 on the transfer, but if there is any gain or loss under the MAT, even that protection was available. But when the original bill got introduced, they gave only protection for the loss in terms of that loss cannot be available. But any gain, which in a sense is a notional and hitting the P&L account, that relief was not available under the original bill, which after the select committee recommendations and the discussions that have been now aligned to even reduce notional gain while computing the MAT, if at all it is applicable. And the last point was that if there is a succession of company into an LLP, then the original bill gave an indication that the provisions of MAT or AMT, which got consolidated under the new bill, it will not be applicable post conversion. However, what it was meant to say that post conversion, the AMT provisions would be available, but the MAT credit, which would have been accumulated during the status of the company, that will not be carried forward. So there has been an provision under the law and simplification of the language to bring out this intention categorically that on conversion from company to LLP, the AMT provisions would be available, but the MAT credit accumulated will not be carried forward and allowed as a deduction. Now we get into the nitty-gritties on the capital gains and the M&A transactions related this. And the first and foremost is on the inclusion of fast-track merger, which is covered under Section 233 of the Companies Act within the definition of a demerger, and consequently to have it as a tax-neutral demerger if the prescribed conditions are satisfied. Now, where's the confusion is arising? Under the current Act, the reference to the demerger definition is still that of the 1956 Act of 391 to 354. But it's in a sense an unwritten interpretation which is taken that even if it is taken under the successor law of 2013, under either the normal provisions of 232 232 of the Companies Act through the NCLT process or through 233, it should get covered. And why this two separate is there? It's just in the government's wisdom to not have small companies or an internal restructuring which is there to get into the entire rigmarole of NCLT, that it's in wisdom have excluded these fast track mergers and demergers from getting to the NCLT route. But that does not mean that it doesn't pass the muster of a detailed scrutiny, because still it has to be approved by the RDROC, which is a government authority, and they go through the entire process to see that the same is for the benefit of the public, or there is nothing which is an avoidance which is there. And it was a specific request when that the original bill only gave reference to sections 230 to 232 and didn't give specific reference to 233, to say that suggestions were made that, okay, you should be given reference to fast track merger. However, the MOF in its response said that no, they do not want to extend that benefit, or that's the intention not to extend that benefit to, because they believe that unlike an NCLT process, this is something which is not, so to say, governed by the NCLT process, and there could be certain aspects for which they will not be comfortable to give the benefit to it. Now, that being the position, so therefore, whether without any specific mention about the section under which the demerger is happening under the Companies Act, and if we go ahead and do the demerger, whether that tax neutrality benefit would be available or not available, again, because of it goes back to what Umesh has discussed, that if one sees contextually the jurisprudence or the interpretation to say that, okay, it should follow on a no policy approach change which is there, then that interpretation should be allowable to have even the fast track merger been covered. But at the same time, since there is no specific reference which is there, there would be definitely a challenge from the department and the judiciary in terms of how they want to interpret. They go by the literal interpretation. If it is not covered, then it is not available, or they go by the purposive interpretation in terms of what has been currently happening to carry on. More interestingly, so the demerger, there is a specific reference to the provisions of the Companies Act. But for the purpose of amalgamation of merger, there is no specific reference to the Companies Act. So it just talks about any merger or amalgamation of two companies. And hence, in that process, since there is no specific mentions of any provisions of the Companies Act, so long as the merger is there as what is understood under the law, irrespective of under which provisions it is there, that that should continue to have the same treatment. But if one goes by the Ministry of Finance intention that since these type of fast track mergers, demergers do not pass the muster of detailed scrutiny of NCLT, there would be certain challenge from the department. But given the plain vanilla language of the law also, here we believe that that should not have any impact on the tax neutrality of the fast track merger.
Yeah, and I think this seems to be a little overstep by the ministry in responding to the select committee, because the conditions for demerger are laid down in law, and I think as far as the eligibility of a demerger for tax purposes, the conditions under the Income Tax Act will prevail, and once those conditions are fulfilled, fast track merger is only a process issue, and I believe the ministry, when they have dropped this hint that because a fast track merger doesn't go through a detailed process review by the NCLT, and therefore casting a shadow on eligibility of demerger, I think is uh, not a happy thing. It will unnecessarily create a lot of issues where, in terms of process, people want to finish the demerger in a faster time limit. But because of this sort of comments that have come, it will create more difficulty.
Agree, Umesh. Two quick comments. One, of course, is that uh, with this comments, litigation on this matter is likely to proliferate. That's very unfortunate. And of course, ultimately, when the matters are resolved in a court, they will take the view independent, as Abhishek rightly pointed out. But clearly, on the one hand, you give a provision to make something time efficient. NCLT is clogged up. Mergers, demergers are taking months on end to sort of complete. And then by putting a window down to say that a demerger, which is fast track, is not eligible to a tax exemption, you are only clogging up the whole process. The purpose is totally lost. Agreed.
Yeah. Moving on to the next. So currently, London capital loss carried forward could be set off only against any London capital gains. But under the repeals and saving provisions of the original bill, it mentioned that London capital loss can be set off against any gains, whether it is short term or long term. This has been corrected now to say that once there is the transition of the losses from the income tax act to the new bill which is there, then such losses would be available for set off only against the long-term capital gains. Here, important element is that while the repeals and savings have talked about how the treatment of the losses will arise either from a business perspective or under any other heads which are currently there, there is no specific reference in the savings laws for the carry forward of the disallowed interest under 94B, which is the thin capitalization rules which is there. So, but having said that, if it is not specifically mentioned, it gets covered under the general clause of 536 because it's an entitlement or a right which is accrued under the current law for carrying it forward under 94B4, and hence that treatment should prevail even under the new law in absence of any specific mention of that under the savings provision. Uh, Again, from a IFSC perspective, any relocation of original fund outside to Indian fund which is there, there was a specific exemption to have that extension up to March 2030, which got announced under the recently enacted finance budget. But that was a miss from an original bill, which has been corrected to state that any relocation between now and 2030, it would still be not subject to capital gains tax. Here again, it was like, and the situation on providing forex benefit, it has seen its own curving upside down, which is there. So initially, for any capital gains tax, you would have got an ability to claim forex benefit for the non-resident in the original currency in which they have been invested. But the provisions of 112 got enacted to say that any capital gains arising to the non-resident on the transfer of a closely held shares will be subject to tax based on INR calculation without giving effect to the forex benefit and the without giving effect to the forex benefit which is there and the indexation. Under the original bill, they mentioned that the capital gains tax available to the non-resident have to be computed after giving effect to the after giving effect to the forex benefit provision as is currently applicable under the capital gains which is there. But the new bill have aligned the position with the current position to say that no, for any capital gains tax, given that the rate is a concessional rate of 12.5 percentage, which is there, there cannot be any further benefit either on account of the forex benefit or either on account of the indexation which would be there. So this position has been there. So one have to compute the capital gains for a non-resident on transfer of the closely held company only on the basis of INR computation without giving effect to the foreign exchange fluctuation. The deemed tax provisions. Again, this is one provision which gets impacted in any M&A transaction and it has been litigated and would be litigated. So in terms of the technical alignment or the language alignment, this thing on the definition of relative, there was only reference to the maternal ascendant which is there and descendants were not there, which they have aligned to say that maternal as well as paternal descendants would be covered under the definition of a relative. But the more importantly, and that's where that the issue arises on the definition of a relative in terms of the relationship of uncle and niece. So any gift from uncle to niece, it gets covered, but from any niece to uncle, it's not get covered under the exemption of 56 to 10 gift tax. And it was recommended that to also provide within the definition of relative the ascendants and descendants of the brothers and sisters to specifically cover that. The MOF came out with a very strong feedback to say that it's a major policy change which cannot be done under the current construct of no policy change approach which is there. But having said that, they have taken cognizance of this, and one may expect that there is some discussion on this to avoid this dichotomy, given that otherwise in other definitions of relative under the different parts of the law or even under the other law, this relationship would have otherwise not covered. So if this happens, then any part of succession planning or resolving the disputes between the family and all, it would get smoothly taken out without any interpretation issue on applicability of gift tax. Having said that,
Yeah, Abhishek, I think these are issues where, again, the ministry, the way they have responded, that anything which is even slightly in the domain of a positive clarification, they have brushed it under the carpet on the ground that this is a policy change. One would expect that such issues should have been adequately addressed, but unfortunately, we'll have to wait for some other day.
yes. And same goes for other aspects of the 56 to 10 related issue on convertible instruments or of issuance of rights and bonus shares. It was recommended to provide clarity on that if the convertible instrument have been invested where the fair market value has been tested and there has been no implications, the subsequent conversion of that, which is basis the terms and conditions as has been laid down right from beginning, there should not be further testing of the 56 to 10 which is there. And same goes for the rights and bonus issue. It should not be applicable where we have seen lots and lots of litigation which is pending before the courts, or either on the waiver of a loan that there is no 56 to 10 implications on that. And more importantly, and given that there have been various off-market transfers of the quoted shares, which are more of a strategic buyout or the strategic high-level transactions for the purpose of acquisition of shares, that is depend upon the negotiation which is there and a particular price is arrived at, that is the commercial discussion. But given the SEBI takeover code provisions, there is first an SPA which is signed, which confirms the main transaction which is there and decided on a particular price. Then one has to follow the takeover code procedure in terms of getting the shares from the other shareholders, and thereafter only one can execute the transaction, the main transaction which is there. Now, between the execution of the binding SPA and the actual receipt of the shares, there could be hell lot of movement on the price, which is under no one's control, and one has to follow the SEBI guidelines to execute these transactions. Now, there has been representations made to the government to please address this issue, especially given that the intent of 56 to 10 is to tax black money. Here it is the thing that the acquisition is governed under the provisions of the SEBI and one has to strictly follow it, and hence one cannot get into any 56 to 10 issue for the difference in the price between the first signing of the SPA and the ultimate acquisition of the shares. Again, all of these aspects in a sense have not been specifically addressed in the new bill on the pretext that these are policy change and that cannot be considered under this provision, but there has been discussions of this in the select committee report. Now, this is very interesting on the carry forward of the tax losses for a closely held company. And one could see various versions of language change between the original bill and the new bill. So today, if there is any change in the shareholding, which happens beyond 49% of a closely held company, and the set of shareholders in the year of incurring of the losses and the year of transfer are not there, then the ability to carry forward and set off those tax losses in the future year is not there. And the language used is that where not less than 51% power were beneficially held by persons. Now, courts under this language have interpreted to say that, and there are for and against decision whether one has to see the immediate shareholding, one has to see the ultimate beneficial shareholding which is there, whether immediate shareholding is the only beneficial owner for that and one need not go to the UBO thing, and we have decisions at both level depending upon the facts of the case. That being the case, in the original bill they coined the term as the beneficial owners instead of the person who beneficially held, which the term beneficial owner has been defined under the law in different contexts, but that term has not been defined under this provision which were introduced. And here the language is very critical, and I'm at the third bullet point to say that if the beneficial owners of the shares of the company carrying at least 51% of voting power shall continue to be the beneficial owner. So the second reference to beneficial owner is to the first reference, which is coming under the first law. And the select committee has actually gone ahead and in fact defined the term beneficial owner, which was akin to a UBO related definition. But the new bill has done away with the beneficial owner concept provided under the original bill, also didn't consequently have any definition of the beneficial owner, and they have retained the construct of the existing bill of beneficially held. But there is a catch here. And if we read the sentence, under the act, the beneficial held by persons which is there, those persons have to be set, those set of persons have to be the same. But the language in the new bill is that the shares of the company carrying not less than 51% of voting power were beneficially held by the person. So, does it lead to any interpretation issue to say that any inter se transfer of shares between the shareholders, which under the current law is not at 1379, and there have been precedents to also support that, whether by virtue of using the term the person, which is the very definitive article, and it only refers to that person who held 51% shareholding prior to the change in the shareholding, whether only those gets covered. Now, if that is the interpretation which taken, it will lead to various anomaly and interpretation issue. First being, the section won't be applicable, or the provisions will always get triggered if there is no single shareholder which is holding 51% at any point of transfer related transaction which is there, and which we can consider by virtue of an example. So A, B, and C are holding 48, 40, and 12. No one is holding more than 49%. Now there has been inter se transfer of shares from B to C, leading to resulting shareholding of 48 to 52 between A and C. Now, if one sees that it has to be only applied to that singular person who should be holding the shares of more than 49% prior to the, or more than 51% prior to the shareholding, it is which that person? Is it Mr. A or Mr. C, or combination of Mr. A and C? So if it is only one person, Mr. A, then these provisions fail in that sense, and one will get into the redundancy into it. The second aspect, and which Umesh also alluded to it, said that it has been the thrust of that there is no policy change approach. So by virtue of interpreting it to say that inter se transfer of the shareholding between the persons cannot get covered under this, under the new language, which only requires the singular person to hold the shares of more than 51%, then is it a policy change approach? And whether then the courts will say that, okay, one have to constructively look into what has been the law under the current law, because there cannot be any change in the policy approach by virtue of a little interpretation of this, which any which ways has its own elements of anomaly of making it redundant under numerous situations.
Abhishek, fully agree with you, and I believe there is enough jurisprudence available both under the General Clauses Act as also under the old Act to say that a singular includes plural, and therefore I think the incorrect use of the word the and not using persons in a plural has created unnecessary uh, issues in the mind of people. But I believe the framework which has been very clearly enunciated by the FM that no policy change, and therefore the way the law was interpreted, whatever is the jurisprudence under the existing provisions, they will continue to apply. And therefore, while this is an area which can create some difficulty, but I would believe it might be reasonable to expect that one need not look at an individual shareholder. Collectively, all the shareholders, if they retain 51%, then the carry forward of laws should be seamlessly available.
Yeah, the only point I would make, Abhishek and Umesh, is that as to whether what was intended, whether this use of singular, plural, what does it mean, etc. If the whole purpose of this new law is to create simplicity and certainty, I would rather that a circular is issued. The very fact that you introduce a bill and it had to undergo some amendment just shows that things have sort of remained a little bit. And I would wish that rather than allowing this matter to be settled by courts and Supreme Court over the years, a circular is brought out to just clarify this position.
And more so, Dinesh and Umesh, there has been discussion in the select committee report of 5,000 on each and every word, but there is no mention of any sort of this shift in interpretation under the select committee report also, which shows that it might not be an intention to bring it under the law. But yeah, a clarification on this would be required given the placement of the wordings under the new law.
And I think our difficulty will increase if the judiciary uses the literal interpretation, because the literal interpretation will create difficulty, which is not harmonious at all. I think say, the existing section 79 or 188 under the new clause may not be capable of application if we look at only a individual person, because there will be multiple situations which may not apply. So one can only be hopeful that this may not create difficulty. But this is the factual situation.
Yeah. We'll come back on this, but let me touch upon the another aspect of the international piece on the definition of the associate enterprise. Under the current construct, there is an subjective criteria under 92A1 and there is an objective conditionality which is there. The memorandum, when it introduced, it mentioned that the objective criteria actually explains 92A1 and therefore it doesn't apply independently. Courts, majority of it have followed this interpretation, though department has been stating that one has to read 92A2 in line with 92A1. And also on the other side, where the conditionality of 92A2 on the objective criteria would have been satisfied, the arguments would have been taken, no, you have to still satisfy on the independent criteria of 92A1. And hence that has been the tussle on determination on the AE relationship in terms of whether only objective criteria applies or one has to see both. It has traveled a lot of water between original bill and the select committee, but the way it has come in the finance bill is that they have adopted something which is like a via approach, wherein they have clubbed the subjective criteria to fulfill as well as objective criteria to fulfill for the purposes of if the relationship arises on account of investment through shares and voting rights, including on the common control. But for all other aspects, there is just the objective criteria, be it on the loan or guarantee which is there. And the intention which the department and the MOF have mentioned is to say that this is in line with the US laws as well, or they have referred to the OECD commentary that both sits alongside in terms of interpreting whether the A relationship is there. But the way they have introduce the provision and with the wide ambit of subjective criteria is there, that if there is any participation in management or control or capital, and while the threshold of 26% is there, but they are asking us to interpret it independently, and this is what they believe that it will bring simplification. But on the contrary, without having provided any guidance in terms of how this subjective criteria needs to be satisfied, even a potential 1% sharing capital or a random decision which is participated would lead to participation in the management or control or capital. While there is some literature or some guidance available on meaning of the term control, either under the other laws, company laws, SEBI laws, which is there, but any participation in the capital, which is independent of the threshold provided under for the 26%, it will lead to an interpretation issue, which would be dependent upon each fact. There cannot be any single thumb rule on this. So in my view, it will only lead to an interpretation issue and hence consequent litigation in terms of determining the A relationship.
Yeah, I think clear recommendation were made to create two buckets. Let the subjective criteria be clarified by more objective criteria, so that a nominal participation in capital does not trigger associated enterprise. But unfortunately, it's not been approved, and finally we are pushed back to the same gray zone as is currently prevailing.
Especially when these provisions were introduced, the memorandum mentioned it specifically as such. So that intention was clear. Now, how that intention got changed, one needs to now understand on that. Again, on the non-profit organization, there has been various changes. So they have combined all the non-profit organization related provisions under a single chapter code, whatever you want to call. So there was a reference to taxing on the receipt of the non-taxable non-profit organization if it is not incurred for the purpose of a charitable institution, which led to an anomaly whether they are looking into gross basis taxability as compared to income, which has to be taxed on the net basis. That dichotomy they have aligned it to say that it would be only on the income, on the specified income, which is not for the purpose of charitable institution. Under the current law, there is an option available to spend accumulated income either in the subsequent year on the pretext that that would not have been received in cash by the end of the year, and hence you need to spend it out in the subsequent year, but then also it would have been treated as an application of the earlier year, or to accumulate it over the period of 5 years to use it for the purposes of the charitable purposes with an intimation to the assessing officer. These two options were removed under the original bill, but this has been restored again to say that there has to be the continuation of the provisions on this, and hence it is basis the current law either to use it under the current law or in a 5 years period by giving an intimation. Reinvestment of any capital gains under the current law is exempt if it is further invested into the capital asset, which provisions were specifically not covered under the original bill. That has now been again restored as such. So on both these recommendations, the new bill have provided the requisite relief. The more important, and which is what the talk of the today's town is on, the philanthropic activities of various promoters in terms of providing assets for the CSR activity, and that generally is provided through contribution of the promoter shares into the charitable institution as and when that requirement is there, because to give that much of cash may not be feasible. And from a non-profit organization perspective, any receipt of voluntary contribution or any receipt of any donation, it's treated as an income, and that needs to be invested into the specified modes, which is commonly known as the 11.5 mode, which is there. And holding the investment in the shares of another company under the present law is not treated as a prescribed mode. So then any violation pertinent to that, okay, if you are holding those shares which is not in accordance with the 11.5 mode, the present interpretation was that only the income arising out of that would be subject to taxability. It will not jeopardize the tax exemption certification, which tax exemption registration, which is there. And at the same time, there was a leeway provided under the law that having received such shares which is non-compliant, you have a period of 1 year from the financial year in which it is received to align it either in the cash or in convert it into the 11.5 mode, which is there. So that 1 year period is still available under the new law, but on the taxability for the non-compliant investment, which today an argument would have taken that it's only applicable on the income, it is now clear to say that it is only applicable, it's applicable on the entire investment amount, which is not in accordance with the 11.5 equivalent mode, which is there. And there has been also the same feedback receiving from the MOF also in the select committee report. So this is something I think which will be has been the ask of the industry for quite some time, to either exempt it so as to promote philanthropic activities and help it for the betterment of the society, which is there. But this is something that has not come under the provision, and whether one can see it to be a policy change, because today only the income is said to be taxable, but in the new regime, it's the entire investment which is there. So whether it is in line with the existing interpretation of the law which is there, that one has to see how the court will interpret on this. Now just get into the small other amendments from the income from house property perspective, and we'll just finish it in next 5 minutes or so. So pre-construction interest is today allowed for both owned and let out. It was missed to be provided that benefit for the purpose of let out, which has been now aligned. If any property is used for the purpose of business, or it is occupied for the purpose of business in whichever shape and manner, that is excluded. The original bill required it to be a compulsory occupation as compared to the manner in which it has to be occupied, which was left to the discretion of the assessee which were there. So hence they have restored back the language of may occupy in terms of an affirmative occupation for the purpose of claiming exemption. The standard deduction is allowed as a deduction before applying the 30% law, which they have retained under the new law itself. in terms of any vacancy period or the vacancy allowance that we for the period for which the property was not given, there were two aspects: whether it has to be given under the normal tours, which also they have removed it to say that in any shape and manner there is a vacancy, there would be a vacancy allowance would be allowable, and that has to be computed only on the basis of actual rent or not on the basis of annual lettable value, which is the market determinant or the municipality determinant rent as such. The capital gain tax rate on the business trust long-term capital has been aligned at 12.5%. It was recommended that to provide a time limit for the disposal of appellate matters so as to have a timely resolution of the pending cases which is there, which is huge in number. But MOF said that it will not be in desirable situation to provide any timelines on the appellate authority for disposal of the appeal which is there. On the personal taxation front, the current construct of default was the new regime, but it is subject to any specific taxation which is available for capital gains, 12.5%, dividend, interest, especially also for the non-resident, which under the original bill they didn't provide that relief, but that has now been written to say that the new provisions of the new tax regime or the slabs which are there, it will be subject to the tax rate specifically applicable for the specific income. From the determination of the residential status, if one goes abroad for the purpose of employment, that need not be a present employment in hand, even then the extended period of 182 days was available. The original bill removed the term for the purpose of employment and it mentioned only for employment, which gave an interpretation that only if you have an employment in hand, but if you are going and venturing out for seeking for the employment or the business purposes, that may not get covered. That also has been aligned under the no policy change approach, and hence today even if one goes outside India in search of the employment, not having that precise employment in hand, that also should be able to claim 182 days benefit. On the search and seizure, and especially from the perspective of the privacy concern, where access to the virtual digital space was provided under the original bill, which has been retained given the larger ramification of the scope available from the search seizure, that it is required to access those virtual digital space, which is given priority over the priority concern. On the withholding tax provisions, one of the aspect was that if one goes for the concession or the nil withholding tax benefit under the present 197, one could have approached for the concession as well as the nil. But they have dropped the reference to nil, meaning that you can approach the tax officer only for the lower tax withholding rate, but not nil, which has been course corrected to say that, okay, you can approach the assessing officer even for the nil tax withholding certificate if the facts of the matter and the law allows you to do that. There has been provided that for determination of the computation of the TDS on salary in terms of which dates forest tenancy has to be applied, that has been provided to be in accordance with the prescribed manner. One important change, which in a sense was not there in the original bill or the select committee, is the time period for filing the TDS or the TCS correction statement, which today is available for 6 years under the law, but they have reduced it to 2 years, and there has been no explanation, no discussion on this. And this is something where I think representations have to be made to bring it aligning with the current provisions of the law. One more aspect was on the refund claim, and that was an interpretation issue that for purpose of claiming the refund, one have to file the return before the original due date, and that has led to a huge hue and cry in terms of ability to claim the refund. That has been corrected to say that under the existing provisions of the Act, there is no requirement to file the return before the due date, and once the return is filed, there is an entitlement to claim the refund as such. So by and large, we have covered most of the topics, and one could have actually gone into various aspects, but those other aspects are more cosmetic or more aligning on this thing. But these are something which are very, very specific and having a huge impact across different sectors and different class of SSC as such. Would be happy to take any questions now from the panel.
Thank you, Abhishek and Umesh. I'm sure you will all agree that we've tried to cover almost all the relevant provisions which represent changes and tried to do an in-depth analysis. It was a whole team which probably spent a couple of sleepless nights trying to just make sure that nothing of importance is left out. And I do hope that all of you on the call really enjoyed what we brought in. Let me hand over to Arun so that we can just look at maybe time for a couple of quick questions, no more. Arun, over to you.
Yeah. I'll from 2025 questions, I have to pick two. So I'll pick the macro ones. This one is from Bhargav Parekh. It's a good one. Whether in respect of proposed enactment of the new income tax bill, the non-acceptance by the government of certain recommendations for amendment on the ground that no policy change is contemplated, can this be relied upon or referred by the department in pending litigation as an interpretative aid?
I put go ahead, Umesh. Please go ahead, Umesh.
No, I think Dinesh continue. So I think I mean if I had to respond, I think it could flip both the ways, and the fact that at least the MOF believes that this is a policy change could create a little burden, but I would generally believe that courts have the independence under the law to take their own position on the interpretation, and therefore if there was a positive assertion by the ministry, that would definitely have been far more beneficial. But given that the ministry has been tight-lipped on certain aspects under the head that these are policy issues, should not create more difficulty, uh, mm, but is only reflective of the government stance on the subject.
We'll go for one more question, and I'm trying to identify.
So while you identify, I think as far as interpretation is concerned, there's one thing which needs clarification that earlier under the Income Tax Act we had provisos, we had explanation. Now the provisos and explanations have all been rolled into the subsection. We clearly have jurisprudence to say that the provisos cannot, they narrow down the main provisions. The explanations can't go beyond the scope of the main provision. Now, because these have been rolled into the relevant subsections, therefore, there is a possible view that these subsections could be independently interpreted. But given the framework that is clearly laid down that no policy change, and therefore there is enough and more jurisprudence currently available, one would expect that the courts, rather than looking at the literal interpretation, will give preference to the continuity and therefore tweak the judicial interpretation to align with the existing jurisprudence. But this is an expectation. The field is open to the courts to take a final call.
Dinesh, I thought it was opposite actually. I met a person who was one of the IRS officers involved in the drafting, and I said that why don't you give a quietus to all the litigation issues by making amendments here in this bill? And he said no, that would mean conceding the position. Now, look at something like a shelf drilling or a ROCA. You have a split verdict. It has to go to a larger bench. The department had an option of introducing that amendment here. They did not. They thought that that would actually concede the case as it currently stands. So, as Umesh Bhai said, it can flip both ways.
I totally agree with you. It can flip both ways, Arun. And somewhere in the line, maybe I am a little bit disappointed that why would the tax office, why would the revenue not take a stand one way or the other? Uh, does it have to be that everything just so today what we are doing is we are abandoning all ultimate action to the courts, and then we say that either the courts are overburdened or courts have no business, but they even go on stray dogs and whatever else. So the question.
But Dinesh, here, would the revenue be fair in saying that they have taken a stand, courts have not?
Yeah, but we have a federal system. We have so many high courts which have given judgments. We are now waiting for the Supreme Court, and the revenue needs to take a stand one way or the other. I can give you a number of examples Arun, where I have been making a representation to our revenue secretary, and the revenue secretary comes back to say, why did we argue like this before the Supreme Court? That's the reality of the situation.
Yeah. Two more questions, and both are very short. One, this is on, do you foresee big changes in income tax rules as well? This one. And after that, the next one I'll come. It's a little more provocative, but yeah, this one. Do you foresee any big changes in income tax rules?
No, again, I think given the spirit of seamless continuity, rule making is going to be a process. One would expect a little bit of liberalization in terms of rules, but clearly a situation where rules will not override the main section can be expected. But generally, I would believe the rules should follow the line of simplification. And generally, the expectation would be that at least as far as the framing of rules is concerned, the legislature and the CBDT will be more liberal and not be very tight-fisted.
Yeah,
But
last
it will have its own challenges on the language interpretation, just as we are having it under the bill.
That's ominous. Last question. Rahul Verma, this is quite provocative. If there is no change in policy, then what is the need for tax bill 2025?
I think, Arun, that's a question which haunts all of us. Clearly, what has been achieved is certain language things, certain provisions being put together, the old provisions going out. As to whether this 100,000 plus hours which went into such an exercise was necessary or not is an open question. But as I said, I'm looking at this as a first step to make the law a little bit of a clean law which is capable of easier interpretation. And then we will see a series of changes which are policy changes. So I see this as a step in the right direction rather than be critical of whether a lot more could have been done or not.
Absolutely. On this one, just something that I'll be honest, and I did not read the income tax bill after passing my CA exam in 2003. I've done that now. That's because we are working on different aspects of the bill. I've had no option but to chip in. And while doing so, we first went to the select committee report. There are over 100 instances or 100 to 150 sections, maybe more, where they have said that this provision is retained with the original intent. I think you have the select committee report saying that we agree to this section because it's retained with the original intent. There are some 200 more sections where this is not said. Maybe there are some variations to it. And then there is a bucket of section like section 9 where any such mention is absent completely. So I think this definitely leaves a lot of room for all of us to say. Plus, as the presentation has uncovered here, you have a select committee which has said something, the original bill which has said something, and the final version which is saying a little bit different than what the select committee said. So to that extent, it's really up in the air whether some of those provisions which ostensibly have been retained with the original intent and with no policy change actually reflect that. So I think that's something that will be up in the air for a couple of years. And anyway, final word to you before we close.
I would make just two quick comments, Arun. One is, who knows what is the intent? So when we had this Vodafone amendment saying this is what the law always meant, who knows what was in the mind of the draftman in 1961? But on a lighter note, I say this ever so often, and I couldn't be more right in this particular case, that there is a conspiracy between the successive finance ministers and the accounting and the legal profession. They want to ensure that we are kept busy, and I'm sure this bill is going to keep us busy for many, many more years to come, with everybody doing the analysis of the type that you mentioned. But it was a pleasure bringing these provisions to all of you. Thank you all for staying in, turning up in such a large number. We had an overflow of people. We had to accommodate people on YouTube. Thank you all, and I hope it was worth your while. Thank you, Arun. Thank you, Umesh. Thank you, Abhishek. And thank you, a large number of people, Murugan and many others who stayed awake to do all this analysis and help us bring this to you. Thank you.
Thanks, everyone.
Thanks.
Thank you.